The world's most powerful central bank has pressed the pause button, but behind that pause, a storm is building. April 29th, 2026, a date that may eventually be remembered as the moment when the global financial system entered a dangerous zone of unstable equilibrium. The United States Federal Reserve, after months of rising inflation, geopolitical chaos, energy shocks, and mounting market anxiety, decided to keep interest rates unchanged at 3.50% to 3.75%. On the surface, it looked like a calm and calculated decision. But underneath that calm exterior, cracks were beginning to appear everywhere, inside the Fed itself, inside the bond market, inside emerging economies, and inside the global financial order that had dominated the world for decades. Because the real question in 2026 is no longer whether inflation exists. The real question is this: has inflation become structural? And if the answer is yes, then the entire post-pandemic economic recovery story may have been built on false assumptions. For most of late 2025, Wall Street believed inflation was dying. Analysts confidently predicted rate cuts. Markets expected the Fed to pivot toward easier money. Investors assumed that the painful inflation era of 2022 and 2023 was finally ending. But then reality struck. Inflation didn't disappear. Instead, it came roaring back. The April 2026 Consumer Price Index shocked markets with a massive 3.8% year-on-year reading, while core inflation, which excludes food and energy, stayed stubbornly high at 2.8%. That single number changed everything. Suddenly, the narrative of disinflation collapsed overnight. And the reason behind this inflation surge was not simple. This was not merely about consumers spending too much money. This was a collision of geopolitics, energy warfare, trade protectionism, supply chain fragmentation, and monetary hesitation. The global economy had entered a completely different era. The first explosion came from energy markets. The Middle East once again became the center of global instability. Rising military tensions around the Strait of Hormuz sent shockwaves through oil markets. Tankers faced disruption risks. Insurance premiums surged. Traders began pricing in worst-case scenarios. Oil prices climbed toward $120 per barrel, and when oil rises, everything rises with it. Petrol becomes expensive. Transportation costs rise. Airline tickets surge. Manufacturing input costs explode. Food logistics become costlier. Inflation spreads silently into every corner of the economy. For years, central bankers believed energy shocks were temporary. They assumed oil spikes would eventually cool down. But 2026 was different. The conflict wasn't ending quickly. The geopolitical risk premium stayed embedded in energy prices. And because of that, inflation stopped behaving like a temporary problem and started behaving like a permanent infection. Suddenly, ordinary Americans were paying more not only for fuel, but also for restaurants, airline travel, delivery services, and household products. Service sector inflation began accelerating again. Shelter costs stayed sticky. Wage pressures remained elevated. And the Federal Reserve realized something uncomfortable. The inflation monster they thought they had defeated was still alive. But energy was only half the story. The second engine of inflation came from Washington itself. The tariff policies introduced in 2025 fundamentally changed the economics of globalization. For decades, cheap imports from Asia had acted like a deflation machine for the United States. Consumers enjoyed low-cost electronics, appliances, furniture, clothing, and industrial goods. Globalization kept prices under control, but tariffs reversed that process. Under new trade restrictions and aggressive import duties, companies suddenly faced higher costs across supply chains. Manufacturers had to shift sourcing strategies. Retailers paid more for imported goods. Shipping networks became less efficient, and businesses passed those costs directly onto consumers. Research by early 2026 showed that tariffs alone increased core goods inflation by over 3%. In other words, trade policy itself had become inflationary. This created a nightmare scenario for the Federal Reserve. Normally, central banks fight inflation by raising interest rates and slowing demand. But what happens when inflation comes from supply shocks, energy wars, and government trade policy? Interest rate hikes cannot produce more oil. They cannot reopen shipping lanes. They cannot reverse tariffs. And yet, if the Fed ignores inflation, expectations become unanchored, and the situation becomes even worse. That is why the April 2026 Federal Open Market Committee meeting became so historic. The Fed decided not to cut rates, but also not to raise them aggressively. This middle ground strategy became known as hawkish neutrality. Officially, the Fed wanted patience. Unofficially, the Fed was deeply divided and uncertain. The internal split inside the central bank became impossible to hide. The vote was 8-4, one of the most fractured decisions in decades. Some policymakers feared inflation was spiraling out of control. Others feared the economy was already weakening beneath the surface. Unemployment had started ticking upward toward 4.3%. Manufacturing activity was softening. Commercial real estate looked fragile. Yet inflation refused to cool. Even more dramatic was the timing. Jerome Powell's term as Fed chair was ending, and a leadership transition toward Kevin Warsh was approaching. Markets suddenly realized they had no idea what kind of Federal Reserve would exist by the end of 2026. Would the new leadership aggressively crush inflation with higher rates? Or would it tolerate inflation to protect economic growth and financial markets? That uncertainty alone created enormous volatility across global assets. And then came the Taylor Rule problem. The Taylor Rule is one of the most famous frameworks in monetary economics. It essentially estimates where interest rates should be based on inflation and economic conditions. By 2026, many versions of the Taylor Rule suggested the Fed should have rates near 5%, not 3.6%. Some models even implied rates above 6%. That meant the Fed was effectively running looser monetary policy than traditional models recommended. Critics argued the central bank was behind the curve. They warned that delaying aggressive action now would force even more painful rate hikes later. Supporters of the Fed countered that tariff inflation and energy shocks were temporary distortions. But markets were unconvinced. Investors began fearing that the Fed was slowly losing control over long-term inflation expectations. And nowhere was that fear more visible than in the bond market. The U.S. Treasury market, traditionally considered the safest financial market on earth, began undergoing a major repricing. Investors dumped long-term government bonds. Yields on 10-year and 30-year treasuries surged higher. The term premium, the extra compensation investors demand for holding long-term debt, exploded upward. This wasn't just about interest rates anymore. This was about confidence. Investors were asking deeper questions. Can the United States continue running massive deficits forever? Can inflation truly return to 2%? Can the Fed remain independent while government debt explodes? America's fiscal position had become increasingly dangerous. Debt issuance continued rising. Front-end Treasury issuance crossed levels exceeding 100% of GDP. Meanwhile, foreign demand for treasuries weakened. Countries like China reduced holdings to focus on domestic priorities. The old assumption that the world would endlessly absorb American debt no longer looked guaranteed. At the same time, inflation volatility shattered the traditional relationship between stocks and bonds. Historically, when stocks fell, bonds usually rose, giving investors protection. But in 2026, both assets increasingly struggled together. Investors demanded higher yields to compensate for that uncertainty. The 30-year Treasury approached the psychologically critical 5% threshold, and markets began whispering about fiscal dominance. Fiscal dominance is one of the most feared concepts in macroeconomics. It happens when central banks become trapped by government debt burdens. In simple words, if interest rates stay too high for too long, debt servicing costs explode, threatening fiscal sustainability. Eventually, the central bank may feel pressured to keep rates artificially lower than necessary just to protect government finances. And once investors suspect that monetary policy is being influenced by debt sustainability rather than inflation control, trust begins eroding rapidly. That fear pushed yields even higher. Meanwhile, another giant force was reshaping the world economy: the U.S. dollar. As Treasury yields surged and global uncertainty intensified, the dollar became overwhelmingly dominant again. The dollar index climbed toward 114, rising nearly 14% from earlier lows. The famous dollar smile returned. Whenever America outperforms, the dollar rises. Whenever the world panics, the dollar also rises. In 2026, both conditions existed simultaneously. The Middle East conflict increased global fear. Energy importing nations suffered enormous pressure. European and Asian currencies weakened. But America offered something unique: safety plus yield. Investors could buy U.S. Treasuries and receive high returns while also hiding inside the world's most liquid financial system. That combination sucked capital away from emerging markets like a giant vacuum cleaner. And that is where the crisis became global. Emerging markets were suddenly trapped between rising oil prices, a stronger dollar, and tighter global liquidity. Countries with dollar-denominated debt faced enormous stress. As the dollar appreciated, repaying those debts became more expensive. Capital began fleeing toward the United States. Emerging market currencies weakened sharply. Equity markets declined. Central banks faced impossible choices. According to international financial studies, a 10% rise in the dollar historically causes severe damage to emerging economies. Domestic stock markets fall. Local currencies collapse. Borrowing costs surge. Liquidity disappears. By mid-2026, this pattern was unfolding in real time. India became one of the clearest examples. The Indian rupee collapsed to a historic low near 96 against the US dollar. Because India imports around 85% of its crude oil, rising energy prices severely damaged its trade balance. Import bills exploded. The current account deficit widened toward 2% of GDP. Imported inflation spread across fertilizers, electronics, industrial inputs, and consumer goods. At the same time, foreign investors pulled massive amounts of money out of Indian markets. More than 2 lakh crore rupees exited through foreign portfolio investors during the early months of 2026. Why take risk in Indian markets when U.S. Treasury yields above 4% offered attractive risk-free dollar returns? This created a vicious cycle. As investors sold Indian assets, the rupee weakened further. As the rupee weakened, imported inflation worsened. And because inflation stayed high, the Reserve Bank of India could not aggressively cut rates to support growth. Domestic liquidity tightened. Borrowing costs rose. Economic momentum weakened. Even India's foreign exchange reserves began declining as the RBI intervened heavily to stabilize the currency. Billions of dollars disappeared from reserves trying to slow the rupee's collapse. And yet, despite all this global stress, parts of the American economy still looked surprisingly resilient. This is what made 2026 so confusing. Some sectors appeared incredibly strong while others showed deep fractures. Supporters of the soft landing theory argued that the U.S. consumer remained fundamentally healthy. Household wealth was still historically elevated. Large technology companies continued generating enormous profits. Artificial intelligence investment exploded across Silicon Valley. Hyperscaler companies poured hundreds of billions into AI infrastructure and data centers. Productivity optimism surged. In this optimistic scenario, inflation would gradually cool while economic growth slowed only modestly. America would achieve the impossible, defeating inflation without causing a severe recession. The so-called Goldilocks outcome. But critics warned that aggregate statistics were hiding dangerous inequality beneath the surface. Wealthier households remained strong, but lower-income consumers faced intense pressure from high food prices, expensive fuel, rising rents, and growing debt burdens. Commercial real estate markets looked increasingly fragile. Manufacturing sectors weakened under higher financing costs. Small businesses struggled to refinance debt. The commercial real estate sector became especially vulnerable. Rising long-term yields pushed property cap rates higher, crushing valuations for weaker office buildings and speculative projects. Only premium trophy assets continued attracting capital. Investors feared that if the Fed eventually raised rates closer to Taylor rule recommendations, credit markets could seize up entirely. And that is why the Federal Reserve's April 2026 decision matters so much. This was not just a routine policy pause. It was a gamble, a massive gamble that inflationary pressures would eventually fade without requiring a brutal economic reset. The Fed essentially decided to look through energy inflation and tariff inflation, hoping both would moderate over time. But every month that inflation stays elevated increases the danger that consumers, businesses, and markets permanently adjust expectations upward. Once inflation psychology changes, central banks lose credibility very quickly. At the same time, keeping rates too high for too long risks crushing debt-heavy sectors, destabilizing global markets, and triggering financial accidents somewhere in the system. This is the central dilemma of 2026. The Federal Reserve is trapped between inflation risk and systemic risk. Raise rates aggressively, and recession becomes likely. Stay patient, and inflation may become entrenched. And hanging over everything is the leadership transition. A new Fed chair means a new doctrine may emerge. If Kevin Warsh pushes the institution back towards strict rule-based monetary discipline, markets may face significantly higher rates in late 2026 or early 2027. But if the Fed continues prioritizing flexibility and patience, bond investors may increasingly doubt America's long-term inflation credibility. The consequences extend far beyond the United States. Every Treasury yield movement shakes emerging markets. Every dollar rally drains global liquidity. Every oil spike changes trade balances across Asia, Europe, and Africa. In an interconnected financial system, the Federal Reserve does not merely influence America, it influences the entire planet. And so the world enters the second half of 2026 suspended in uncertainty. Technology offers extraordinary productivity potential. Artificial intelligence promises economic transformation. But geopolitical conflict, protectionism, fiscal expansion, and energy instability are pulling the global economy in the opposite direction. The result is an unstable equilibrium, a fragile balance where optimism and fear coexist simultaneously. One path leads towards soft normalization, moderate growth, and controlled inflation. The other path leads toward aggressive tightening, financial stress, and disruptive global realignment. For now, the Federal Reserve has chosen patience. But history shows that patience in monetary policy can either become wisdom or become the first step toward a much larger crisis.